We are constantly told to think of the economy as a perfectly tuned machine, like an intricate clock where every component must align just right. In that kind of system, even a tiny adjustment can ripple outward, triggering second or third order effects that end up being catastrophic. We have seen this before, a modest change to banking rules that spiraled into the worst economic collapse since the Great Depression, or a seemingly minor shift in a foreign currency that erased trillions of dollars in market value almost overnight. Those moments were clearly major shocks to a fragile structure, but at the same time, over just the past 12 months, we have rolled out massive tariffs only to cancel them, re-announce them, cancel them again, announce them once more, briefly enforce them, reverse course again, reapply them, increase them, cut them back, carve out special exemptions for certain firms and countries, revoke those exemptions, drag the whole issue through the courts, and now potentially face having to refund all of that tariff revenue. And now somehow we are putting them back in place again against countries that refuse to hand over Greenland. On top of that, we have openly threatened our closest allies and biggest trading partners, gone after the chair of the Federal Reserve, singled out individual corporations, destabilized core pillars of consumer finance, and restarted debt repayment programs that many people had been acting like didn't exist anymore. All of this happened while we simultaneously overhauled healthcare policy, laid off tens of thousands of government employees, rehired most of them, fired some again, and then shut down the very department responsible for those layoffs in the first place. And through all of that, we kept piling on new debt at record speed because of one of the largest tax overhauls in decades. We lived through the longest government shutdown in U.S. history, dramatically reshaped both legal and undocumented immigration within the labor market. And that's not even touching the more ominous developments inside the banking system, like the Basel III endgame stalemate, which has left banks unsure of how much capital they are actually supposed to hold. None of this is meant as a partisan critique. Some of these issues, like student loan repayments, were always going to need resolution eventually. But regardless of where you fall politically, it should be obvious that the system is under extreme stress right now. If the economy is supposed to operate like a precision Swiss watch, then we have been pounding on it with a jackhammer, and yet it's still running. During this same period, economic output continued to grow, unemployment stayed relatively low, wages increased, and the stock market, which is supposedly allergic to uncertainty, has remained near record highs. Of course, there is plenty of nuance behind these headline numbers, and they do gloss over some serious underlying problems. But that's exactly the point. Many economies with far fewer internal weaknesses have collapsed under much lighter pressure. Given the sheer scale and intensity of the disruptions we've experienced, it naturally leads to one question. Why hasn't the economy fallen apart yet? And the first answer that probably comes to mind is the same one we've discussed repeatedly on this channel over the past year. Massive AI spending is propping up the top-line figures. There are genuine structural flaws in the economy, but the enormous sums tech companies are pouring into AI infrastructure have effectively papered over those cracks. Underneath the surface, decay is still happening, but from the outside, things look passable enough. According to the Bureau of Labor Statistics, GDP was growing at an annualized rate of 4.3% in the third quarter of 2025. We don't have fourth quarter data yet, but unless something dramatic pulls the entire year down, those numbers look strong. That said, a large share of this growth is now coming from trillions of dollars being spent on data centers and advanced chips, rather than from everyday consumer activity. That's not exactly reassuring for the world's largest consumer economy, but that part likely isn't new to you. What may be more surprising is that, according to the BLS itself, total investment across the economy actually dipped slightly in the third quarter, which dragged down the overall growth figure. So how can investment be both the main force keeping the economy afloat and yet barely register in the broader picture? The answer is simple. This is a net number. AI-related investment on its own would add roughly 2.5% to growth, but that boost is being almost entirely canceled out by companies gradually running down their inventories. When a business or an individual purchases inventory or another produced asset, it counts as a positive investment. When that same inventory is sold, it is subtracted from that category. This accounting method exists to prevent double counting. For instance, if a machine shop manufactures a component in one quarter, stores it for a while, and then sells it in the following quarter, only one item was actually produced, so only the final sale should be reflected in the data. What companies have largely been doing over the past year is offloading goods they stockpiled before the tariff chaos fully kicked off. The drawdown in inventories has almost perfectly counterbalanced the surge in AI-related spending. That means if this wave of AI investment were to slow or stop, the economic picture would immediately look far worse than it does today. Still, that isn't the entire explanation. We will get to consumer spending shortly, but before that, government spending and the trade balance also, somewhat surprisingly, appear very strong. Government outlays are higher because the net effect of the so-called DOD cuts was minimal, and military spending has increased as well, which makes that part fairly straightforward. Trade, however, deserves closer scrutiny because the numbers don't behave the way most people intuitively expect. A drop in imports actually boosts GDP, and the data shows that we are exporting more while importing less at the same time. That leads to an uncomfortable question. Are the tariffs actually doing their job? The short answer is no. But to understand why these seemingly positive figures may actually be more dangerous than they look, we need to take a closer look at how money really moves through the system. This video is sponsored by Monarch Money. Monarch Money is a private, ad-free personal finance platform that pulls all of your accounts into a single clean dashboard. It automatically tracks your spending and net worth, helping you stay on top of your finances without relying on messy spreadsheets. Rather than just telling you where your money went, Monarch helps you understand the bigger picture, adjust intelligently, and move toward your goals with confidence. With bank-level encryption and read-only access, it's secure, and thousands of users have rated it 4.9 stars. I started using Monarch for my monthly budget reviews, and it has genuinely changed how I manage my money. All of my accounts, cards, loans, and investments sync from over 13,000 institutions into one polished view on both web and mobile, saving me from bouncing between apps. I especially like the flexible budgeting system that separates fixed and variable expenses using customizable rules and categories. The insights explain spending shifts or unusual activity in plain language, so I stay informed without being overwhelmed by alerts. Watching my net worth trend over time and seeing clear timelines for savings or debt payoff makes progress feel tangible and motivating without the stress. You can try Monarch yourself by using the link in the description and entering code HMW50 to get 50% off your first year. So yes, imports into the United States are down right now because tariffs have disrupted business purchasing and because those same companies stocked up earlier in the year and are now working through existing supplies. This isn't a story of consumers suddenly choosing domestic products after tariffs made foreign alternatives more expensive. In many cases, there simply is no American-made alternative. That's not ideal, but at least exports are rising, right? And technically, exports have increased, which sounds surprising given how strained our trade relationships have become. That surprise fades quickly once you look at what we're actually exporting. By far, the fastest growing export category is precious metals. Between October 2024 and October 2025, total exports rose by $26 billion after adjusting for inflation. Of that increase, $14 billion came solely from higher gold exports, representing a staggering 517% jump compared to the previous year. Part of this surge came from the fact that every ounce of gold we sold was simply worth much more. But that price increase largely reflects a global push to diversify away from the US dollar and into reserve assets. It's hard to frame that as a clear victory. Even after adjusting for prices, we have still shipped out a greater total volume of gold to traditional wealth safe havens like Switzerland and London. On top of that, roughly another $4 billion in export growth came from higher silver exports, representing an astonishing 2,800% increase year over year. Altogether, out of a $26 billion rise in exports, about $18 billion is explained by increased gold and silver sales, with most of the remaining $8 billion coming from military equipment and energy products. So yes, the trade balance looks strong, but largely because businesses are afraid to rebuild inventories and because we are liquidating precious metals. On paper, the economy appears healthy, but this is a bit like claiming your household finances have improved because you are eating through your emergency food stock and sold your car. For the moment, the cash flow looks fantastic, but that strategy obviously can't continue indefinitely. Maybe it's overstating things to call this a fire sale, but other countries rushing to pull fungible stores of wealth out of the United States as quickly as possible is generally not a comforting signal. And unfortunately, the story doesn't stop there. Normally, strong consumer spending is a reassuring sign because people tend to spend more only when they are earning more or feel confident they can afford it. Looking at the data, even with all the unusual activity in the other four major GDP components, consumer spending still accounts for the majority of net economic growth. But there are some important caveats. The first one is exactly what you're probably tired of hearing by now. A record share of that spending is coming from the wealthiest households. That means this growth doesn't necessarily reflect broad-based confidence among consumers, but rather the fact that affluent individuals have benefited from sharply rising asset values. For the purpose of this discussion, though, that distinction actually isn't critical. If the economy were truly being damaged by all this instability, or even if these households believed serious trouble was ahead, we would normally expect them to cut back as businesses struggled, bonuses shrank, or investments underperformed. Instead, they're doing the opposite. In fact, spending has become so aggressive that a record number of very high-income households are now experiencing financial stress. That may be a terrible decision at the individual level, but it has allowed businesses to continue producing large volumes of goods and services, even as they increasingly cater to a much narrower, wealthier customer base. So maybe the warnings about an imminent economic collapse were overblown, right? At this point, you probably already know where this is going. Let's take a closer look at one positive number and explain why it may actually be a negative signal. A large share of the recent growth in consumer spending came from healthcare and other non-durable goods, which the Bureau of Labor Statistics notes are dominated by pharmaceuticals. It's no secret that insurance costs and prescription prices have risen for most families. But these statistics are designed to adjust for price increases and focus on the actual volume of services delivered. That means there are three main forces driving this surge in healthcare output. The first is straightforward. We simply need more medical care. A report from McKinsey summed it up bluntly, noting that Americans, on average, are getting older, heavier, sicker, and less engaged with their own health. The second factor is the rapid expansion of treatments like GLP-1 drugs, which has significantly boosted demand for pharmaceuticals. The third driver is fear. Many people worry they could lose their health insurance in the coming months, creating a use it before you lose it mentality. Layered on top of all this is an enormous web of bureaucracy and misaligned incentives, which I'll be breaking down in a dedicated video next month, so make sure you're subscribed for that. In the short term, all of this activity shows up as higher consumer spending, because healthcare and pharmaceuticals are extremely expensive, and when you truly need them, very hard to refuse. Hopefully, this adds some important, if slightly bleak, context to what looks like a red-hot economy on the surface. The growth itself is real, and there's no denying that. But many of the forces driving that growth are either temporary or unavoidable rather than optional. And that's before we even get to the largest caveat of all. Yes, the economy may have expanded by roughly 4%, depending on how the fourth quarter data ultimately shakes out. At the same time, the US dollar has declined by more than 10% against most other major currencies. It's not as simple as saying that this automatically leaves us 6% worse off. But a rapid drop in currency value like this quietly makes several economic indicators look stronger than they truly are in the short term, while also signaling potential trouble ahead. Take the stock market as an example. It has climbed to record highs, which helps explain why affluent households remain comfortable spending freely. But when those same market gains are measured in many foreign currencies, the performance looks flat or even slightly negative. The weaker dollar has also made American exports cheaper for foreign buyers and imports more expensive for domestic consumers, which helps explain why both of those categories appear to be boosting growth at the same time. Someone who sees their investment portfolio rise by 10% over a year may feel confident enough to loosen their spending a bit, but when an overseas vacation or an imported vehicle suddenly costs 10% more, domestic alternatives start to look much more appealing. If the United States were a net exporting economy, this currency shift could actually provide a modest advantage by improving global competitiveness. The problem is that we aren't. We are the largest net importer in the world, so the primary effect is simply higher prices across the board. This is happening on top of tariffs, which research from the Kiel Policy Institute shows have been overwhelmingly paid by consumers. The study examined the final prices of 25 million transactions and found that foreign exporters absorbed only about 4% of the added cost, while the remaining 96% was passed directly onto households. So yes, we are importing fewer goods, but paying more for each one. That's not ideal, but it still doesn't amount to the kind of collapse many commentators have been predicting. The truth is, it's simply too early to draw that conclusion. The American economy isn't indestructible, but it is both enormous and highly privileged. The sheer scale of our consumer base and financial markets means economic shifts don't unfold as quickly here as they do in smaller countries, that global institutions can exit much more easily when risk rises. On top of that, the United States is tied into a dense web of long-standing agreements, alliances, partnerships, commitments, and informal understandings with nearly every major economy that matters. Those relationships have clearly been strained and tested, but no matter how turbulent things get, they don't unravel overnight. In the short run, that's actually a benefit, because it gives us time to recognize problems as they emerge. At the same time, it also means that if other countries, investors, and customers begin working around the United States instead of alongside it, the damage will take much longer to reverse. It certainly doesn't help that many of the decisions shaping this moment are being made by people who won't be around to deal with the long-term consequences. But if you want to understand how the baby boomer generation is gradually losing its long-held grip on power, watch the next video. And don't forget to like and subscribe if you want to keep learning how money really works. If you want more videos breaking down stories like this, make sure to like and subscribe. Thanks for watching.